If your mortgage is renewing in 2026, please do not sign your renewal letter yet. I know that sounds dramatic, but stay with me for a minute because right now, Canada is entering the largest mortgage renewal wave in history. Over 1.15 million homeowners are renewing within the next year, and roughly 60% of them will face higher payments. For many families, that's an extra $300, $400, even up to $600 per month. And the real danger isn't just a higher payment. It's getting trapped in the wrong mortgage with the wrong terms and no flexibility later. So today I'll show you what the data says is coming, what's happening here in Greater Vancouver, the biggest renewal mistakes I'm seeing, and what you can do now to stay in control, right? Let's dive in. Between 2020 and 2022, many Canadians locked in 5-year fixed mortgages at historically low rates, 1.5% to 2%, sometimes even lower. And at the time, it felt great. Payments were predictable, budgets were comfortable, but fast forward to today, those terms are ending. And even though interest rates have come down from their peak, they are still much higher than what most homeowners are used to. Here's a simple example. You bought a property for $600,000 and you put 10% down, so that's $60,000. You get a mortgage of $540,000 plus your mortgage insurance premium, typically 2 to 4% of your mortgage amount if you're putting less than 20% down. In this case, it's 3.1%, which is equal to $16,740, making your total loan amount $556,740. Amortize that over 25 years, you get payments of $2,224 per month. And at the end of your 5-year term, your balance remaining would be around $461,000. Now you're renewing at 4% with a 20-year amortization remaining, so your new monthly payments would be roughly $2,785. That's a difference of $561 per month. That's not small. That's real household money, groceries, childcare, car payments. And that's why 2026 is being called the renewal cliff. Okay, so an option you may have is if you reamortize your mortgage to 25 years, which then your monthly payment would drop to about $2,425, which is around a $200 difference from your original payment. Or we can go further and you can explore reamortizing to 30 years, which could make your new payments close to or even lower than your monthly payment before. And in this scenario, it would be about $2,200. Now, some people think maybe the housing market will bounce back. Maybe prices will rise. Maybe this will all work itself out. So let's look at the data. The Canadian Real Estate Association does forecast a modest recovery in 2026. But here's the key part. They've downgraded those forecasts multiple times over the last 2 years. And many analysts now believe spring 2026 won't be as big as a comeback as they thought. Why? Well, because at the same time, homeowners are renewing, payments are rising, job confidence is softer, and home values haven't grown much. So simply waiting or just doing nothing is not really a strategy. Now let's bring this home to Greater Vancouver because local market conditions matter a lot when it comes to your mortgage options. So here in BC, home prices are down roughly 4 to 6% year over year. Fraser Valley prices have dropped around 6%. And Vancouver sales volumes recently fell below 2008 financial crisis levels. And that matters because your home value directly affects how much equity you have. So whether you can refinance and how much flexibility you truly have at renewal. So many homeowners who bought after 2021, especially with less than 20% down, are discovering they have limited real equity available, which means refinancing isn't as always as easy as they expected. A lot of homeowners assume if payments go up, I'll just refinance. But in a flat or even a declining market, that equity may not even be there. And banks are becoming more cautious again. They're tightening income servicing measurements. They're scrutinizing files more closely. So some homeowners are finding out, like way too late in the process, that they don't qualify for the refinance that they were counting on. This is exactly why starting early matters, because once you're inside the final weeks before renewal, your options get very limited very fast. Now, the Bank of Canada has already cut rates from 5% down to roughly 2.25%. So those cuts help variable rate borrowers, possibly prevented a housing crash, lowered short-term borrowing costs. But here's the important part. For most renewals, payments are still going up compared to 2020 and 2021 loans. So yes, rate cuts helped, but they did not erase the renewal payment shock. Now, here's some good news. Since late 2024, if you're switching your mortgage from one major bank to another major bank, you no longer need to re-stress test. Well, as long as everything stays the same, your amortization, your mortgage amount, the applicants, etc. That means you can shop your renewal, compare lenders, negotiate confidently. And however, banks are still tightening income qualification rules though. So don't forget that, which means the earlier that you start, the easier this process becomes. Now let's talk about the biggest renewal mistake I see. You receive a renewal letter in the mail, you quickly glance at the rate, and you just sign. But posted renewal rates on bank websites are often much higher than real market rates. And more importantly, it's not just about the rate, it's about prepayment options. Lenders have different rules about how much extra money you can put towards your mortgage. It's also about penalty structure. Make sure you know how much your penalty is or how it's calculated should your circumstances change and you need to exit the mortgage or refinance. Some mortgages have penalties so high, they effectively trap you for the next 5 years. If rates drop, if your life changes, if you need to restructure, you lose flexibility. So the real risk isn't just paying a slightly higher rate today. The real risk is signing onto a mortgage that removes your options tomorrow. Now, let's talk about solutions because you do have options. First, shop and negotiate. A mortgage broker can compare big banks, smaller banks, credit unions, monoline lenders, not just to find the better rate, but to find a mortgage with better terms and lower penalty risk. Second, lump sum before renewal. So putting extra money down before you lock your new term can permanently lower your new payment. Third, debt consolidation. So rolling high interest debts like car loans, credit cards into a lower mortgage can reduce your total monthly outflow. So if you're paying 20% on a $20,000 credit balance and you're consolidating that to your 4% mortgage, that's a no-brainer. Fourth, re-amortization. So extending your amortization can lower payments short term, as I mentioned before, but it does increase the long-term interest. So remember, it's not a relief tool, not a wealth strategy. The fifth thing is fixed versus variable. So let's do a quick comparison. Right now, if you were to get a $600,000 mortgage, monthly payments for a 3.49% variable rate mortgage over 25 years would be about $3,000. Versus monthly payments for a 3.89% fixed rate mortgage at the same amortization would be about $3,130. So fixed gives certainty. Variable may offer savings, but the right choice depends on your comfort with risk, not headlines. There's no universal answer, but there's always a best structure for your situation. So if your mortgage renews in 2026, here's what to do. Start planning 9 to 12 months early. Do not sign your renewal letter blindly. Run payment simulations and check your real equity position. Compare multiple lenders or let us mortgage brokers do this for you. Ask specifically about penalties. Prepare documents early. Early planning gives you options. Remember, late planning gives you limitations. If you're feeling uncertain, that's normal. This is the largest mortgage renewal wave Canada has ever seen, but you are not powerless. With the right plan, you can protect your flexibility, manage your payments, and confidently make decisions. If your mortgage is renewing in 2026 and you want clarity before signing anything, if you're going to take anything from this video, explore your options early. I'm Evangeline, mortgage broker and partner at All Trust Mortgage Solutions here in Greater Vancouver. And if you found this video helpful, hit like and subscribe and drop your questions below. I'll see you in the next one.